Hi, it's Angela Torville and Mike Torville, your hosts of Get Moving, the real estate roadmap with the at-home team, where we're going to provide you with the education, tools, and unfiltered talk to keep you in the driver's seat. Thanks for joining.
Hi, everybody. Glad you're back with us at Get Moving. I'm Mike Torville, your co-host, along with
Angela Torville.
Thanks, Angela. Thanks for coming today.
Thank you, Mike, for always having me.
Yes. Well, you're always going to be here, I hope.
Leaves me no choice.
We've got lots to talk about. We're going to talk about your favorite topic today. You know what that is?
Mortgages.
Well, not mortgages. Something about mortgages. How's the word rate?
Oh, yes, the R word. Yes. Yep, that's a topic of conversation most days.
If you haven't tuned out yet. But actually, we're going to try to dive through, because when people call, it's often the first question I used to get, and I'm sure you get it, it's like the first, before they even ask about programs, down payment, before their goals, they say, what's your rate? And you go, oh, please. I sometimes liken it to somebody calling a restaurant and say, how much does your food cost?
Right.
Well, look at the menu, because there's a variety of things you need to consider. Look at it. You have a dessert, you have an apps. Well, so let's ask some questions first, right? So let's find out what exactly a person needs to do or what position they're in, because the rate is determined by so many things. It's not just what's your rate. All right, it's 6 1/4. And they'll say, well, I can get a better rate. Like, let's just pause.
All of a sudden, everyone turns into an investor.
Right.
They're shopping for interest rate.
And I don't blame people, because that seems to be the target. Oh, if I get the best rate, that's hooray for me.
Yeah, they win. Yeah.
Well,
there's a deeper meaning behind rate, I feel,
there sure
with
is.
most consumers.
There sure is. And we could talk. We're not going to. We could talk for an hour. We'll cover the topics in a pretty short time. So, well, do you find that when people call you and say, hi, Angela, I'm Joe, I'm looking for a mortgage, what's your rate?
I usually stop them and I say, you're asking the wrong question. And they should ask me what.
Are you trying to be evasive?
Well, I mean, they need to ask me what their rate is, because I have a lot of rates. And the foundation of a rate is 8 factors per person.
8?
There's 8 factors in building a rate. And then on top of that, there's choices behind it. So you need a specialist. It's not, online has made people think it's one rate fits all, and that is not the case by any means.
Talk about a couple of those factors of the 8. I don't know if you can memorize all 8, but let's talk about a few of the important ones.
Yeah, I mean, everyone knows credit score. Big one.
Okay, well, let's dive into that. Credit score, the higher your credit score, the better chance of you getting a lower rate.
Maybe.
To put it in the simplest terms.
Well,
right?
if we're just talking rate, the answer is maybe.
Maybe.
I've definitely seen a 760 FICO with a higher rate than maybe a 620 FICO.
And that depends on the remaining factors.
Product,
right. So credit score is probably one of the first things you look at. But
that's one of the main.
It's one of the main ones.
Yeah.
What else?
Are you purchasing? Are you refinancing? Are you refinancing just to drop your rate, or are you refinancing to take cash out? Those are factors.
Or consolidate other debt.
That's cash out, correct?
Yeah.
What type of house you're buying? Your condo?
How does a type of house make a difference in the rate?
Single family, condo, multifamily, those are going to be rated different. How are you living in the house? How are you going to occupy that home? That's also a big factor.
So back to the restaurant analogy. If you're having steak, fish, or a hamburger.
Yeah. You're not going to get the hamburger.
It's not going to cost you the same.
Yeah.
So, okay. So we got property type. We got product, program, in other words, refi or purchase. You got credit score. Products, in other words, if it's a government, FHA, conventional.
Yeah, product's a big one.
Down payment.
Down payment's going to matter. Absolutely. Okay. Loan amount's going to matter.
A loan amount.
Yes, correct. So I see a lot of people, obviously payment is really the core of this, right? What people are looking to get is the best payment. Most people aren't investors. That's a different scenario.
So let me ask you a stupid question, but it's a common question, and this comes up a lot, and I know you're going to look at me funny. Can you get a lower payment with a higher rate?
The answer is always maybe.
maybe. You can. It happens.
Yeah, absolutely. I
And
just
so-
showed a scenario like that the other day.
Exactly. I know we were talking about that the other day. How do you get a lower payment with a higher rate? Sometimes that can be like, wait a second, that doesn't make sense because there's other factors in terms of, well, we can get into that. But so it's not, the bottom line is it's not always down to, I got 6% or 5.75. That's the deal, because there's other factors that could alter that rate. We can talk about points a little bit too.
We could, yeah.
Because points paid up front, which is really prepaid interest, drop your rate. They discount your rate.
Yeah.
And that's the whole idea. So if somebody's shopping for a rate for a mortgage, calling several lenders, what
Yep.
should they be prepared to answer in order to make sure they're being given the appropriate rate and program? In other words, how should they say, I need to know these things before I start shopping?
Well, you're definitely going to want to know your credit score.
How would I know that?
I usually recommend Experian.com.
Okay, they can do it on their own.
Yeah, credit score could be a whole other podcast.
Yeah.
You're going to need to know the range of your credit score. It's
Okay.
always going to be different,
Yeah.
no matter when we're looking at
Because there's
it.
usually 3 credit bureaus and there's 3 scores, and
Yep.
you take the middle one. But if they get a score, at least you'll have an idea before they apply.
Know the range of where your
Know
score
the
is
range.
at.
Yeah, that's helpful. Yeah.
You know, honestly, I always say first build your trust with the individual that's going to lead you on the lending side. Trust is real important in this type of situation. Narrow it down to 2 or 3. And honestly, you really should be putting in an application, possibly with a soft credit pull, because there are so many product scenarios. It's very granular and very personalized. So if you're going to get quotes, I wouldn't do any more than 2 or 3. You don't want to confuse yourself. And once you have that application in, you're going to want to request a loan estimate worksheet, because there's more behind that rate than just the rate on the front page. Okay. And so to really get an apple to apple quote, you need to see all the costs, the fees, the rate, the APR. That's an important number. And honestly, you can try to get guided through, ChatGPT if you'd like. And you might get some good information, but you might need someone to explain it in a different manner to you as well, right? So if you trust them, you're going to get a valid quote, and then compare all 3.
In those quotes, in those loan estimates, right? And you're right. You don't want to do too many.
No, it's just
Drive
crazy.
yourself crazy, and then you have to.
And definitely don't go with what's the best rate today.
Yeah,
Okay, because that
It's a
is
moving target.
That is just a bright shiny object.
And so you've mentioned something too, and we know it, but let's just talk, because a lot of people it doesn't come up. What's your rate? Okay, what's your rate? It's more than that, because it's the closing cost, it's the associated fees and everything. But you mentioned APR, okay? And explain what the difference is between APR and your interest rate.
Sure, your interest rate's what you're going to pay your mortgage back based on, right? That's what the amortization schedule, your payments are figured out for that number, from that number, and a couple other factors. But your APR is going to incorporate some of the costs of the loan, okay? So like your origination fees with the lender, some of the attorney fees will be in there. So, there's manipulation that can be had. So when you're looking at the APR, that's not the interest rate you're paying your loan back based on, but it's a way to sort of like whole shop your quote, right?
So if the total cost, right? The upfront cost of some of your closing costs.
Some of the fees, yeah.
Along with your rate.
Correct.
And it gives you what, I guess,
A percentage.
A percentage that is higher than the rate, because
Correct.
it incorporates that.
Yeah.
So the APR typically is higher than the rate because it incorporates those other costs.
Right. So if you had 2 rates that were 6.5, and one APR was 6.75 and one was 7%, what's happening there?
Right.
Higher fees on one of them.
Yeah.
And those fees can be in multiple departments.
Right.
So again, that's why a loan estimate worksheet, that's going to itemize the quote for you. And you can hold on to that as proof, right? Because you want to, you can put whatever you want on an estimate. Things are always subject to change. So if you have that as a consumer, you get an estimate, let's say from online.joe, and that's the best rate and it looks beautiful, and you go to lock it in, and all of a sudden it changed, or they're dodging your call, things like that. You got this loan estimate worksheet. You say, this is what you quoted me. I need to know exactly what changed and why I'm not getting that option today.
And if you have a borrower and it says, hey, I can get 6%, I can get a lower rate, call it 6%, at Bank X down the street. And you say, either you're going to say, great, good luck, have fun, or you'll say, listen, I'd be glad to take a look at that. Do you have a loan estimate? So you can actually, like you said, compare apples to apples.
This morning,
Yeah.
dear client of mine financed their first home. We used, some grant money. It was a beautiful purchase for them a few years back. They're now getting solicited, but my clients tend to come back to me to consult them. So they were being offered a 15-year at 4.99 on a cash-out refinance. There is going to be a pretty big APR on that one, I think. And so she just assumed, hey, no one can beat this. This is the best. Ange, can you even beat this? And what do you think my answer was, Mike?
Let me take a look.
I need a loan estimate worksheet, because that's probably just an online floater. I mean, I think it was Credit Karma that quoted her that. Again, back to, and I will never let go of this and really truly believe in this, you need a mortgage advisor in your corner if you own a home, because there's just so much of that out there. That rate could cost her $15,000 of equity in discount points or origination fees. She doesn't know that. She's looking at that front page, the front page of the book, right? She's not reading into the chapters, which is difficult to do as a person who doesn't do this every day. So trust in an advisor is key.
Yeah, and I think you're right. Having something to demonstrate you've actually have all the information, or if you don't have the information, say, here's what you need to find out before you sign. If I tell you, go get that 5% rate and take it while you can, but before you commit, take a close look. Or show it to me so I can at least tell you what the differences are, so you can compare apples to apples. Because, you're right, they could use up some of their cash to pay some of those discount points or whatever is associated with that low rate, or their equity if they're doing a refinance. Whichever, it's a chunk of change that...
well, it's very likely with a refinance, because the lender can say to you, and this is very typical, you can do the refinance for no money out of pocket. Doesn't mean it didn't cost you $30,000.
Right. And bringing that up, some people might say, oh, wow, I didn't realize that. So let's talk about a few of the red flags that people could notice, right? So if you say, hey, I'm shopping for rate, I got bank X is giving me a super duper rate, and I'll go ahead and beat that. What should they be aware of, a borrower be aware of, that might give them a sign that the rate there might be more behind it than they see?
Right away, they're not giving you a loan estimate worksheet or say that they need a contract or your signature on disclosures to issue that form. That form they're talking about is actually called a loan estimate. So there is a form called a loan estimate worksheet, which can be provided prior to commitment to that loan. But most lenders are going to try to get your commitment, and that is a red flag.
Yep, and I think what happens is two programs. Which program is it? Is it a government loan? Is it a conventional loan? What's the program? Which encompasses several different aspects of the loan, right? Is it an FHA loan, or is it conventional? Are you putting 10% down, 20% down? What other factors?
Great point, because usually if we're doing a cash out refinance, you can only use 80% of your home's value, so you have to leave 20% of your value on the table. And typically with the conventional loan, that would remove the requirement for PMI. But now if that lender placed you with a primo rate in an FHA loan and you still have 20% equity on the table, guess what you're paying? 2 PMIs, one up front, financed into your loan, and one monthly for the life of the loan. So what is that 4.99 doing for you?
There's another thing that happens. Unrealistic promises or unrealistic timing, because when you quote or lock a rate, it's for a given period of time.
Correct.
When you have an estimation of I can close this in 30 days, so I'm going to lock it for 30 days or 45 days, depending. And the longer you extend the lock, the more it may cost. But some of these rates advertised are 14-day locks.
Oh, yeah, probably.
So pressure.
Yeah. Absolutely.
Pressure. And then what happens if a lender says, yeah, we can close you at 5.5%. Oh, great. And then you find out, well, you have to close next Tuesday. Okay, well, wait. So then you have extension fees, which negate the savings of that lower rate.
Correct. Yeah. I mean, it's so much. So on your loan estimate worksheet, you're going to find your rate expiration date. Pay very close attention to that. And very likely, you're going to have some skin in the game, whether it be a refinance or a purchase. You're going to have some money up front in this transaction. So execution is very important.
And trust.
Always trust. Yeah. That's like the number one thing. You should be interviewing people Do not click the bright, shiny object. You can click it, but interview that person. Really have a conversation before you sign or fill out anything. I believe in that 100% with my business. And I know that's not the norm, but I can't stress it enough.
Sometimes, sometimes lenders might be evasive or might appear to be evasive. And it's not intentional, because you're trying to say, no, I need to know more, because it's just the opposite. I'm trying to be transparent. I'm trying to be honest, open, and tell you the realistic picture here, right? Because I need to know more information. Before I shoot out, you want me to shoot out a rate, and then it turns out I can't give you that rate, I lost credibility.
100%. Yeah.
So I've got to do my research. To give you a true answer, I've got to know these things.
You know what's a big one?
What?
That would never, even if I didn't have an application on a client, I asked these screening questions, provide them a blind quote. Their income matters. Your income level could possibly adjust your interest rate.
How?
It's a loan level price adjustment. And so if you're within the area median income, depending on the percentage of that and where you live, and depending on what you qualify with. So let's say somebody is within the area median income. So here in Hampden County, it's about 50% of it's about $77,000 and some change. Okay. But let's say you have bonus income too, which might put you at 90.
Okay.
Well, maybe you need the bonus income to qualify. So now you're over the AMI, you actually get a charge on your rate for that. If we don't need the bonus income to qualify, we can remove that from your application and keep you within the AMI and get a better interest rate. So, I mean, it is so detailed, guys. Bright, shiny object clicking online is just not the way to go.
It is. And then, there's beyond that, rates are a moving target. They change how often?
Minutes.
Every day.
I mean, every day, but sometimes within minutes.
At minimum, every day.
Yes, of course.
And sometimes multiple times a day.
Yes.
And within minutes. So if you give a rate quote, once you know it's a legitimate quote, right, based on all those parameters we talked about, at 10 o'clock, it could be slightly different at 3 o'clock.
Absolutely.
And so you have to qualify that and say, here's the situation. These rates change every day.
Yep.
And it's likely to change one way or the other, depending on, and you can get some indication that they may go up or down. So you might encourage, or at least talk through, whether it's important, whether it's appropriate to lock your rate, secure your rate for that period of time you need to close it, and ensure that's going to be that rate, or float it. And so talk about floating versus locking.
Yeah, floating, you're just sort of floating around in the ocean of the mortgage world, right? So depending on what that rate environment's doing, if you didn't lock in your rate, you're not safe. Or maybe you are. So market watching is important.
It's important.
Yeah.
And if the loan is marginally approved, right?
Oh, yes.
And yet
many stories.
Right at a rate, and you might say, look, if the rates go up, we might put you above the required debt-to-income ratio. And if that happens, you may not be approved. It might make sense to lock in now to ensure the approval. Right?
Yeah, I mean, a real scary one, and not to deter people, but as you're pre-approved and before you go under contract, you can't typically lock. Sometimes there's available options to do that, but not normally. Yeah. So as you're shopping for your home, you could have been, prime example, can I give another story?
Yeah.
So this is a few years back when rates went from 3 to 6 overnight, basically. So we had people, first time buyers. I definitely had a couple of them that were shopping in the market. They were getting down payment assistance, and they had to fit within the restrictions of that program. Well, their offers were accepted. Next day, we had a huge interest rate hike. I had 2 clients lose their assistance, and we had to pivot quickly to get money for them, find money. Where can we get this down payment? How can we replace it? So not only did they didn't qualify for that product anymore, but they also lost their down payments because we can't lock until the contract was there. And it happened overnight. So there's a lot on the line. You really need someone advocating in the background for you and watching and watching and watching. Yeah. I definitely have strategy to avoid that. Typically, that was a crazy, COVID world that we were in at that point. Things are a little steadier now, but there's ways that you can be protected from that mostly, but with the right team again.
And it doesn't mean it won't happen again. I mean, there's lots of things that happen. And you know, one of the things that's
we closed those guys, by the way.
You did.
They got
Well,
their
of course you
houses.
would've.
Yes, they got their houses.
You're a
we
good
figured it out.
You're a good problem solver, and
We did
I'm sure you
close.
did, because you always have to have that pivot, and now we
Yeah.
have to recalibrate things and put this in another program or adjust something. And you know, the other thing too is people will get hung up on a rate. Let's just use 6%, 6.5% as a
Sure.
okay, and let's say a $400,000 home, putting down 20%, the loan amount's $320,000. Okay, and that's probably average in this area,
I would
right?
say,
Ballpark. And the difference between a 6.5% rate and a 6.25% rate is about $52 a month.
Okay.
Okay, I'd like to save $52 a month for sure. Okay?
Yeah.
But it goes the opposite way too, right? It could raise it $52 a month if
Right.
you are hedging, and then it goes up, and then you say that hesitation, that anticipation of a drop turned into an increase, and that cost me $52 a month. So if you're comfortable with a payment and you qualify at a payment, sometimes it's safe to say I'll take a lock and I'll take that rate because it's not worth having to pay 52 more. Yeah, everybody wants to say it. I might be able to save 52, but is it worth the risk of having to pay that? And so it's a fine balance here. And so you say, well, and every eighth might matter, but then you just take that and you say, well, an eighth difference, I want 6.375 instead of 6.5. It's a $26 save. Are you going to potentially get disqualified over $26 a month? And that's just an example.
Yeah, I mean, personality
Yeah.
types definitely come out in those conversations.
And
We, you know,
Or professions, right? If you are doing a loan for an engineer, you might be on the phone for an hour and a half. Could be.
Maybe.
I've done a few.
yeah, they like to dig deep.
Nothing against engineers.
They like
In
to
fact,
dig deep.
I respect that.
I
It
love those conversations.
It keeps you on your toes. But let's talk about how that might go, because one is somebody wants to save money and they say, oh, I think the rate's going to go down. Let's wait. And then they go up instead.
Yeah.
Shoot, we lost that opportunity. Those conversations, you have those kind of conversations?
Of course. I will never decide for you to
Right.
lock. or
That's.
float.
I'm glad you said
Never.
that. You
Ever.
never decide
No.
for somebody, but
Absolutely not. But I will provide the right knowledge for them to
Yes.
make that decision. And that's what I mean by personality types come out. You see the riskier people, you see the more conservative people. But yeah, you have to, you know, I believe in you just have to give options and give the why behind so that they can make that decision. And if they made a decision to float and things went up, they have to be okay with that. That was their decision, right? I'm here to give the advice, though. I know when the feds are meeting. I know when big reports are coming out that could affect the market. And cool thing though, if there's any loan officers listening, they know this. If you like it, lock it. Same as what Mike was just trying to say. If that payment's comfortable, just lock it. And here's what could happen:
yeah.
if rates drop significantly after you locked, most of the time, not every institution is the same, but I think most nowadays will allow what we call as a float down. So actually you could float down based on that decrease in the market, even though you're locked. But however, if it goes up, you will not go up.
So it's protection.
It's definitely a safe way to go. Now, there's a little bit of cost behind floating down. It's usually 1/4% charge based on your loan amount. So if
Okay.
it's a 25%, charge to closing costs. Typically, everywhere's so different, but that's sort of the norm.
Yeah.
But yeah, so if you like it, lock it. And if there is a large improvement, usually a full percentage point, we're talking a real significant improvement in the market.
Has a significant
Which would be a
impact.
quick change in the
You're
market.
right.
But I mean, there is that option too, right? And so there's just so much more behind rate. I mean, even then we can still protect and do different things. I mean, there's so many factors in there. It's crazy.
There are a lot of factors. Yeah.
It's like asking the mechanic how the car was built and trying to learn it all in 10 minutes.
And go home and tell somebody.
Yeah, and then they actually build one.
Yeah. And which is
But
another
literally.
thing. Yeah, because if let's say a loan officer at a bank, a mortgage company, tells a borrower something and goes through all, let's say we've been talking for 20 minutes here and says, repeat, I'm going to repeat everything Angela and Mike said, and then they hear it and then they go to repeat it to somebody else,
Telephone game.
it's not going to match up entirely.
Yeah.
Most likely. So that it's important to look at the loan estimate, look at all these factors. Another thing we didn't talk about, and we'll talk about it briefly because people say, well, points. Paying points. What does that mean? How does it work generally? When you pay points, a point is basically a discount point to discount your rate, and it's effectively a prepaid interest. You're paying some interest in terms of a discount point up front to reduce your interest rate for the long term. And you can make a decision to pay 0, 1, 2 partial points, half a point, where it makes sense for qualifying purposes, for comfort in payment. Maybe you have more cash to pay points and your cash flow needs to improve, so you discount. There's lots of reasons to pay points.
It's personalized.
It is very personalized. And it's never, hey, does it make sense to pay points? Well, that depends. It's kind of like taking an application. Let's take a look and see what makes sense for you, what your comfort level is. And maybe there's other creative ways where a seller could pay points in terms of the credits for closing costs and so on. But how does a point equate to a rate decrease? Generally speaking, and it's off a little bit, a point will reduce your rate by about 0.25%, generally. It's not always exact, but just for the sake of conversation and simplicity of determining that. So 6.5% rate would 0 points. You might pay 1 discount point to get 6.25. If you pay 1 discount point, or using that same example, $320,000 loan, that would cost 1%, which is
$3,200.
Wanted to see if you could do the math. You can do the math, right? So $3,200 up front to reduce my rate by 0.25%, which then equates to a $52 a month savings. Am I willing to pay $3,200 up front to save $52 per month? Well, let's look at it. Does it make sense? It makes sense because the break even is at about 61 months. Call it 5 years. It's a 5-year break even, and that's roughly what it falls into when you pay points. It's about a 5-year break even, generally, okay? So am I going to be in the house for 5 years? Will I stay in this house for 20 years and I'll be happy I got the lower rate because I prepaid a discount point for a temporary, cost and long-term rate reduction?
Do I think I can refinance in a year or 2 or 3 or 4 or 5?
Right. Or if I know this is a transition house and I'm going to be in it for 3 or 4 years, it might not make sense to make points because you're not going to be in it long enough to break even. But those are the conversations you have with people.
You have to.
Yeah.
Yep. Everyone has different goals.
Right.
Different, scenarios.
And so paying points might make sense. It might not make sense. Or there's a sweet spot in there that makes sense.
I find right now, with the high cost of things, budgets are very important, and in front of everybody. I don't care what income level there are out there. You could be making $300,000 a year, and that housing expense is still something you're very much considering. So I am finding most people are paying points right now, and it does make sense. And my advice tends to be a little more conservative than a 5-year break even.
Okay.
For the last 3 or 4, I've been consulting with a 3-year break even. And most of my clients that took that advice have not had to refinance in the opportunities we're hearing on the news, because there are opportunities to refinance if you didn't do it smart. So a lot of my clients, they're paying points that is going to break even with their monthly savings in a 3-year window. And also that number they're paying for points, that fee, is typically less than what it would cost to actually refinance. So they're saving in both avenues, and they're all happy. And everyone's, can I refinance? Not yet. We still got to wait, And so here we are 3-4 years down the road. They're still sitting pretty on rates under market still today.
That's a great point.
Yeah.
Yeah, that's something that you have to consider, because you never have the answer until you learn from the person what's happening,
Little secret sauce too. I mean, this isn't just money people have in their savings account. So let's say we have a first-time home buyer who's doing down payment assistance. We can typically use some of that money to help buy down that rate. And I'll tell you what, I typically do. It makes a whole lot of sense.
So it doesn't always have to be used just for your down payment.
Exactly. Yeah, some down payment assistance options do allow excess funds where we can put them towards costs, and a lot of times it makes a whole lot more sense than putting it to the rate rather than
and you can't
as down
generally
payment.
Find out that information when you're going online and finding a quick lender who's advertised a rate, because there's things behind it that say, one of the things you want to give all the information up front, have that conversation. Because later on, you don't want anybody to say, "Guess you know what I could have done? I had no idea I could have done this, or could have applied these funds to that, or could have dropped my rate if I looked at it a different way." There's so many things.
Yeah.
Having that guidance, that conversation, like you said, talking to a mortgage advisor, because then you talk through the whole thing. And what I like, and I'm sure you do too, at the end, people say, "Wow, okay, I have a lot more to think about." That helped a lot, and you say, "Well, glad."
Well, and also no frustration. I mean, they're
Right.
satisfied. They're fully satisfied with their decision on their own.
Yeah.
No one's deciding. They feel good.
Yeah.
They feel good. And you want to be able to feel good after you get the keys to that house and not look backwards and say, I can't change it now.
Right.
Because
Or-
I just didn't understand what was happening.
Exactly.
So here I am in a situation that I'm living,
Yeah.
and I do understand it now. And in hindsight, I wish I did prior.
Exactly. That's what you don't want to have happen.
That's the
Exactly.
whole thing. The whole
yeah.
point in having a good team behind you. People have accountants. People have financial planners. Why do they not think of having mortgage advisors when they own a home?
The biggest liability or debt that you have, it needs to be talked to. And we always say, talk to your financial advisor when you're looking at a loan program.
Yeah.
Because does it make sense for your personal situation? There's so much to it. And, we talked about this for a while, and I know we're going to wrap up in a minute, but in our book, Get Moving,
Yeah.
Chapter 6, we talk all about the rates.
Yeah.
It's all in here. So if you're interested in obtaining our book, there's a lot more that we do dive into, trends of rates, when it makes sense to pay points, what the rates might look like, and a lot of what Angela said about the factors that determine your interest rate. So, and also you can always reach out. But before, the overall message here is, while you're shopping for a mortgage, ask the questions, get the information, get a loan estimate, and then you're just better informed, right?
Yeah.
Any last words on the rate? Think we covered it?
Yeah, just know who you're working with, guys.
Yeah, know who you're
If
working
you
with.
can't see them in person, on Zoom, or get them on the phone for 20 minutes with a real conversation, I would look elsewhere.
Yeah, there's just more to it than meets the eye on the screen.
You're not alone. You
yeah.
don't have to be alone in this. You're not against the loan officer if you have the right one.
If you have the right one. Something that you said that they're happy about. They say, okay, I got a good rate, good program that fit me in my situation.
Yep.
Wonderful.
I feel good about it. Yep.
Well, good. I feel more informed.
Yeah.
So,
Well, when you're ready for a quote, Mike,
all right.
you know who to
I'll
call.
call you. Yeah. I'll ask you to do some quick calculations.
Yeah. Woo.
All right. Well, that wraps up this one. So I'm glad you're here. Glad you're listening. I hope this was helpful. We'll be back soon, and we'll talk to everybody soon. All right.
If you have questions in the meantime,
Yeah.
feel free to shoot me a text. No problem. It's easy. 413-302-2215.
That's great. Thanks, Angela.
Thank you, Mike.
See y'all soon.